Warren, you say Australia, unlike the US, has avoided creating an underclass of working poor, but with inflation now starting with a 5 and wages growth with a 2, are we at an increasing risk of doing that?
Well, it looks that way. The living standards of many Australians have been compromised by this surge in living costs, this rising inflation, and I think this minimum wage decision that we're coming up to is critical. The real minimum wage has declined by just over 5% in the last 2 years, and another modest increase in the minimum wage, followed by another year of 5% inflation, which is the expectation, we'll see quite a big backward step. And I think that's the path to where the United States got themselves all those decades ago.
You said this week that lifting the minimum wage by 5% would be good for the economy. Why?
Look, I think the priority in terms of fighting inflation has to be monetary policy. Low interest rates and accommodative monetary policy ahead of the pandemic did not produce inflation, but it is now. And I believe that's going to remain the case for a number of years to come. So I think the real priority here has to be to get that cash rate up at least 2.5%, if not higher. And to do that now risks doing quite a little bit of damage to the economy. I think the impact on the housing market will be clear, but we don't want to derail the broader economy. And if we have a broad range of workers in our society going backwards, those higher interest rates could really hurt their spending. And we're starting to see that in consumer confidence, which is soft. So I think a lift in minimum wages in order to keep real wages stable is critical to that process of normalising interest rates without risking a recession.
Of course, critics say, though, that there's a risk of a price spiral if we do start to see that. What do you say to those critics?
Well, two things. One is the process of raising interest rates will deal with that excess demand for labour in the economy over the next few years. Secondly, beyond the Fair Work Commission's decision, I think you'll see that wages are starting to head towards 4 to 5% in the broader economy anyway. And finally, the Fair Work Commission's decision is for 1 year only. And a wage price spiral is all about entrenching inflation expectations within the private sector, I might add, and being an ongoing problem. The Fair Work Commission can quite easily follow up next year with a much more modest increase in the minimum wage, which I would expect them to do. This is really a one-off reset after a couple of years where inflation's come in much higher than anyone expected, and the minimum wage has not been able to keep pace.
Some economists suggest a wage hike slightly below headline inflation of 4 to about 5.5%, with future wage hikes in line with inflation. Would that be more effective if it wasn't such a hard hit to begin with?
Look, I think an outcome this year of 4 to 5% is okay. I think my argument is another 2.5 or 3% outcome is going to be putting us at risk of those issues we discussed before. 5 is just a round number. Of course, it's the political hot topic of the day. So really, I think when all is said and done, if it's sort of 4.25 to 4.5, then that achieves much of it. And of course, we need to see how the economy responds to higher interest rates, and the Reserve Bank can't dawdle on this. And I think if there's a good solid base for the minimum wage this year, that gives them even more confidence that 100 basis points or even 150 basis points of rate hikes in short order will have a much reduced chance of derailing underlying demand in the economy. Of course, it'll hurt the housing market, but I don't think anyone is going to be surprised by that. So I think it's actually a really important part of the process of adjustment within this economy.
Of course, if we do see, a 4 or 5% increase in wages, that's going to hurt some employers. What's the solution for those businesses?
It's really, really tough for SMEs at the moment, and I speak to them all the time. And there is no skirting around this. They're having to deal with higher costs, and wages are going to be part of that story. So I think the Fair Work Commission decision needs to reflect what I think is happening more broadly in the economy, and businesses have to respond to that. They have to respond to that importantly, by trying to invest in labour-saving technologies, whether that's new plant and equipment, digitalisation, whatever the option is for a particular business. Beyond that, if we start to see genuine and undesirable stress emerge, the government has other policy tools, whether that be within the labour market, some further reform of labour markets for particularly smaller employers, or they could even temporarily cut income taxes for small business. I mean, there are other ways to address it. I just don't think that keeping real wages in decline is the healthy and appropriate approach to the economic challenges we've got. And if we do see the stresses emerge in the SME sector, then there's other policy tools we can employ.
Of course, next week we will get the numbers on wages that we've been waiting for and the latest monthly labour force data. What do you expect they'll tell us?
Well, the wages should show a further acceleration from last year, but they'll still be low. I doubt we'll see annual wage growth much above 2.5 to 2 3/4. And that's because these figures measure the whole labour force, and the labour force is only going to be repriced, for lack of a better word, i.e. everyone get a wage review in these new circumstances over a period of time. I mean, theoretically, some people have to wait 3 years with an EBA. So I don't expect to see the wage pressures that we're currently observing in the economy show up in these numbers for at least another year. And we know they're there anecdotally, as well as through things like the NAB business survey. So they're coming through, but I don't think we'll see them next week. The employment report will be critical, as it always is. I suspect we'll see another reasonable number, and I think there's a very good chance we'll officially have an unemployment rate with a 3 in front of it. And of course, that really just highlights that this is the right environment to do these wage adjustments. You know, it's a much harder ask when unemployment is high or higher than full employment. But when full employment has been achieved, now is the time to do these adjustments to wages.
Warren, in the US, inflation slowed this week. Can we expect it will start to come down, and would we follow suit here in Australia?
We definitely have seen a peak. We'll see lower headline inflation. Core might take an extra couple of months. The base effects, the inflation, monthly inflation figures from last year were huge. So we will see inflation come down in the United States and in Europe. It's just how far and how quickly. That is the big question. Now, we are lagging these developments, and it's very hard to understand precisely why, but we are. And so our inflation rate is going to continue to rise until probably Q4 of this year, when we'll probably put a high in my view. So what happens overseas is absolutely critical to getting a sense of where we're headed and how high inflation can go here. And I believe, and I've been arguing for 6 months, that was the case. And we're now starting to see that higher inflation show up here. So I think the real issue for every economist in Australia is to be looking overseas and seeing how quickly they can bring inflation down, even though interest rates remain very low, even though the economy is doing pretty well, but also markets are very volatile. So there's this real conflict going on between economic momentum, financial volatility, and tightening of monetary policy, which makes it an extraordinarily tricky environment for businesses, investors, for everyone operating here.
Warren Hogan, great to have your analysis. Thank you so much.
Thank you for having me.